Can you please elaborate for us on spread trading, what you know a little bit about that?
Thanks, John, for the introduction. And you're right. There are a wide range of approaches to trading the futures markets, from following candlestick or footprint charts, from trading option strategies with names like condors and butterflies. There's just an enormous catalog of trading strategies and tools available for traders to consider.
Such a colorful group of terms in our industry for some of these strategies, aren't they? But you're here to talk about future spread trading. And aside from your experience trading those future spreads, what's so worthwhile about spreads that traders should know about them?
So, first of all, the basic definition of a futures spread is when you have a single position in the market that consists of simultaneously purchasing one futures contract and selling another one. And they're related to each other in some way. So, for example, a long July corn is matched with a short July soybean, or a long June lean hog is matched with a short December lean.
Okay, all right. But why bother advancing this strategy? What makes future spread trading worth looking at?
So, good question. So you would consider this. Some of the most invested players in futures trading, and you would argue maybe some of the most sophisticated, are large speculators, commercial firms who regularly employ spreads. These are the traders in the futures markets who actually buy and sell the physical commodities we trade. So that would include farmers, ranchers, other food growers, food producers, petroleum companies that either drill for oil or natural gas or refine these products, financial institutions with enormous holdings in treasuries or stocks or currencies. Also, mining interests in gold, silver, copper, other metals available for trading, and then all of the buyers of these materials on the other side. All these areas of production and distribution employ spreads from time to time as important aspects of their businesses. So, spread trade, it's a fundamental and essential part of the commodities futures markets.
So what you're saying then is there's a lot of spread trading going on out there. That's really interesting. But still doesn't answer the question, why bother with futures spreads? Just because they're heavily traded, so are a lot of other markets. The E-mini S&P sees a couple million contracts traded every day, for example. Crude oil's first few contract months see a million or so contracts a day.
Right. And those are hugely liquid and popular markets. So that's a good question. Why would you say, for example, buy an August soybean and sell a November soybean, right? On the surface, that looks like just a knucklehead trade. So 2 points. First of all, futures contracts can become extremely volatile, not just during their U.S. daytime trading hours, but overnight when traders do other things like sleeping. Volume and liquidity can be diminished significantly. So one aspect that we're talking about, future spreads can greatly reduce volatility risk and can be a viable substitute for placing stop orders for a single contract, for example. Also, because of the reduced volatility risk, the exchanges set margin requirements for a lot of these spreads that can be much less than the outright futures position. So, for example, just a current initial margin requirement for August soybeans is right around $2,400. The current total for the spread that we mentioned, that long August, short November soybean spread, is $715.
So that's all well and good, but what advantages come with lower volatility and lower margins? Mark, those qualities by themselves don't seem to make future spread trading worth pursuing, but buying an out-of-the-money futures option for $200 is also low in volatility and risk. So what say you?
Right. So I get that. So here's where I would start. First, when we go back to who uses spreads that I mentioned, those same large speculators and commercial firms who regularly employ spreads, again, these are some of the most invested players in futures trading. They are employing spreads based on market conditions and events that, and here's kind of the crux of why we like to use spreads. Those events recur at periodic intervals. So I'm going to point out one of the most obvious of these intervals, obviously, is the cycle of weather from warm to cold and back to warm again. For agricultural and energy futures traders, weather and the changing seasons can have an important effect on price movement. So, for example, enormous supplies of soybeans, once they're harvested, they tend to dwindle throughout the year after harvest.
Okay.
The same goes for other agricultural commodities such as wheat, corn, sugar, and cotton. Seasons and weather changes affect energy prices as well. Demand for heating oil typically rises as cold weather approaches, but then it subsides as refiners meet the anticipated demand. Memorial Day, for example, typically marks the beginning of the quote-unquote driving season in the United States, and similarly, a vast number of the rest of the world's population prepares to go on holiday. As a result, gas consumption rises.
That makes so much sense.
So seasons and weather changes are a big part of why we use spreads. They're not the only cycles out there. Cycles in the financial arena can affect related futures markets. So you consider, for example, how one country's fiscal year and tax due dates often are at variance with others, and those are
Sure.
important trading partners. That can have an influence on currency flows and the forces on interest rate sensitive instruments. So, and again, all these forces that we're talking about, they are not 100% predictable, right? Annual cycles ebb and flow. Seasonal patterns don't repeat without fails. They have price activity and tendencies, but they're not always perfect.